Hello friends, David here. Welcome back to this YouTube channel. So, the US Fed just increased interest rate from 0.25 to 0.5% recently. The Fed does this to slow down inflation. When interest rate goes up, the cost of capital, the cost of borrowing money goes up. Business will pass this cost to consumer and hence prices will go up. When things are more expensive, people will hold off spending, which reduces the consumer demand. When consumer demand decreases, this leads to growth slowing down and hence reducing inflation. The keyword here is monetary supply. When money becomes more expensive to obtain, there will be less money in the circulation. Lesser money leads to lesser growth and hence slowing down inflation. On consumer level, when interest rate goes up, people will stop buying house. For people who already own a house, their home loan will be more expensive and therefore have less money to spend. Because of higher interest rate, people will also put more money into fixed deposit. Both instances, the decrease in spending and the locking of money into deposit reduces the monetary supply in circulation and hence reduces inflation. On the business level, because the cost of capital has gone up, business need to pay more to service the same amount of debt. Business growth will slow down due to less consumer spending. This reduces the profit margin and hence reduces the company's stock price. Tech sector will be the first to be impacted. Their business are more prone to a slowing economy and usually borrow more money to expand their business, except for Tesla. Financial sector will be the first to benefit because they can earn more from the increase in interest spread. If you are thinking to invest into financial sector now, you are 3 months late as the market moves in anticipation of the future. And hence, you saw a tech sector sell-off since December last year. Typically, the market will recover after interest rate hike. 75% of the time, the S&P 500 index will return to positive within the next 6 months after an interest rate hike, and 100% of the time within the next 12 months. Tech sector will benefit the most after a rate hike. The Fed will introduce 6 rate hikes this year. Assuming each rate hike is 0.25%, this will bring us to 1.7%. This is aligned with the FOMC consensus. And in 2023, FOMC consensus is a further hike to between 2.5 to 3%. This figure has increased as the Fed expects higher inflation than previously thought, from initially in the range of 2 to 3% in December last year to the range of 3.7 to 5% in March this year. But the key issue here is not about the rate hike, but the larger problem is the supply constriction. The energy issue in China and the war in Ukraine, which will further constrict supply. Referring to my previous example of supply and demand, increasing interest rate is only addressing the demand side of the equation, not the supply side. When the pandemic subsides, when the war stops, when China opens up, as supply chain resumes to normal, this will reduce inflation to a larger extent. Wrapping up, unless the fundamentals issues are resolved, the market is still in a risky condition. Doesn't matter the recent pump in share price because the fundamentals are still the same. My approach is not to FOMO in with the recent pump, but to continue to dollar cost average as there will be more volatility ahead. Invest safe.